Hello everyone, my name is Tom and welcome to Eagle Academy with Eagle Investors. And today we're going to be going over diversification, hedging, and risk. Mainly all of this entails risk management. And so what is risk management? Well, really the key here is that you're going to win more than you lose. You're going to reduce the effect of your losses on your portfolio, be able to capitalize on gains more effectively, and really entails different types of strategies such as allocation, diversification, and hedging. So the first key strategy is obviously allocations and limits. What usually you'll see traders do is never put in more than 5% of their portfolio into a specific position for a kind of normal to high risk trade. For more of a passive strategy, sometimes we'll see 5 to 10%. But for larger accounts, usually what you'll see the most successful traders do on more active trades and high risk trades is actually stick to the 1% rule. So nothing more than 1% of their total capital to be put into a single trade. Now, if high risk, obviously, again, don't go above 3% allocation, and for larger accounts, that is going to be 1%. The other thing successful traders do is using stop losses and trailing stop losses. We're going to go over a couple models and theories at the end of this presentation that shows the effects of using these stop losses and trading stop losses over a period of a couple of years. And then again, using limit orders is actually a very underrated way of helping you maximize potential returns and not getting squeezed out of a position too quickly, especially on more active trades. It's very possible to get in based off momentum, have your kind of risk reward set or your stop loss set, and then it kind of move against you very quickly since you may have bought too high on that momentum, not having kind of a limit order for where you want the trade to be filled out, and instead kind of get that market order with momentum can get filled much higher than you would want, which is going to reduce your risk reward profile, especially if you stop losses at a technical level that doesn't change. So kind of a hard stop loss and not a trailing stop loss, and that'll potentially get you squeezed out of positions much quicker than you would have wanted to. But even if you don't, it just generally is going to always reduce your potential return. And using these limit orders, again, can make you kind of even more sure of the trade you're going into using a limit order, stop loss, and then kind of price target, limit sell. All of that combined makes for a trade that you know exactly what you're getting into. Combine that with allocation, and you have a very good understanding of the risk now that you're exposing yourself to within your portfolio. So the second is diversification. Diversification is obviously the opposite of unsystemic risk, which is essentially, or is the opposite of accounting for unsystemic risk. In this case, you're really accounting for systemic risk, which is kind of market risk, the risk associated with investing in markets in general. Unfortunately, the systemic risk is always going to be present, but there are ways to reduce it. And the key to all of this is adding non-correlated assets in classes such as bonds, commodities, currencies, real estate, or even equities, but in different sectors. So holding these assets in different industries or sectors, that the key is have different betas to the general market or to even your portfolio. It's going to be very important. Obviously, a beta of 1 is going to be one that is directly correlated with another asset. Having a much lower beta, say 0.2, 0.3, will help, if the general markets or if tech goes down and you have another sector ETF that has a low beta to tech, when tech maybe goes down, that sector ETF will actually continue maybe just staying steady or even outperforming. And so that reduces your max drawdown. It also reduces your risk on your portfolio and creates something much more balanced, much more or much less volatile as well. And so adjusting these sector assets as well based on market conditions, if you're trading on a more active portfolio, can also help to reduce that systemic risk even further. And so a lot of what we saw actually 2020, 2021 as well was the shift between growth versus value stocks within a kind of portfolio. So that's a perfect example of that. But ultimately, using non-correlated assets eliminates the highs and the lows in performance and can create just more balanced, consistent returns. Now, another way of doing all of this is actually kind of hedging. You can use non-correlated assets to hedge to a degree if they have a very, very low beta. You can also use, shorting a stock, a small position short, to counter the exposure you have from a very long position that takes up a large capital allocation. Even if it's in not just one trade or one position, you might have multiple positions open that are going to be correlated to tech, and you're going to want to maybe short tech at the same time, because getting a low beta sector ETF, maybe industrials to tech, is just not going to be enough. If tech just crashes one day, it's not going to be able to make up for those losses. And so you want to have something that can help that. Hedging really is most effective when you have large positions where the drawdown can be quite extreme, and you're going to need to find a way to make up for some of these losses, essentially reducing them, especially if you're trading with a lot of volatility. Hedging makes a lot of sense. And the best way to do that, actually, to a degree, is also using other securities like options to help maximize the risk reward ratio, where really you kind of get to a point of that maximum downside when you start wanting to hedge or have the hedge start to take place, where if you have a certain gain at that price target limit, the cost of your hedge will not completely eliminate those gains. That would defeat the whole purpose of a hedge. But if you get to closer where that hedge or where your stop loss would be, and if you start to see much higher drawdowns than that, but you don't want to use a stop loss, because again, the on a much larger position, the drawdown might actually be quite extreme, you can start using hedges like options. And options, put options in particular, is actually the most common. Really betting that underlying stock will go down in price, because with the leverage of options as well, you can reduce the cost of getting into a hedge, meaning again that you're not taking away from that potential gain within the risk reward, but that your kind of bottom points of that, even if you don't use a stop loss, where the hedge really starts to come into its own with more volatility, what you end up seeing is that actually it'll make up for a lot of the losses that can occur, minimizing your losses. And even if you get out of that long early on enough, if you're kind of doing that active portfolio, that hedge will actually potentially even make up the losses, and sometimes even create some gains. And so in very volatile environments, using stop losses can be effective, but you can get stopped out quite easily, and therefore using a hedge can make sure that you're not getting stopped out randomly, but at the same time, you're making sure that it acts the same way as your stop loss, where below a certain point, you're not going to be losing any more money because your hedge just makes up for all of those losses at that point. So now let's go into kind of analyzing some of these different kind of strategies, mainly maximizing your risk reward by using stop losses, and the importance of stop lossing in risk management. And so the reason risk management matters, especially with stop losses, is that it's actually going to be able to, over the long run, significantly outperform certain indexes and certain strategies, even if you have an active or passive portfolio. And so here we're going to look at the performance of stop loss rules, whether it's a traditional stop loss or a trailing stop loss, versus a just buy and hold strategy. And for anyone that has a portfolio that they're planning to keep or are keeping over a longer period of time, this data will actually be really interesting, because it came from over a period of 11 years, from 1998 to 2009, meaning that it included the tech bubble crash and the housing market crash. So quite a lot of very large volatile events between those years. These stocks, the one caveat is it's on the OMX Swedish exchange, since it was done by a Swedish professor, this study. But really the kind of correlation and volatility that they experience, again, from 1998 to 2009 is very similar to things like the kind of what the stocks on the New York Stock Exchange show. So there's no real different kind of data or outperformance or underperformance that you're gonna see there. And so let's kind of analyze this. Essentially, this is the trailing stop losses. What you see on the right is that this B&H, this blue line, is the buy and hold strategy. This pink line at the bottom is a 5% stop loss, trailing stop loss, 10% trailing stop loss, 15% trailing stop loss, 20% trailing stop loss, and so on, all the way to 55%. So ranging from 5% to 55% for these stop loss levels, trading stop loss levels. And what this graph really shows is actually a 20% trading stop loss gets you the highest mean returns. So these are mean returns over certain periods, especially 07, 08. We saw significant outperformance in this strategy over just a buy and hold pattern, even prior to that, but especially during these very volatile events. We see that the 20% trading stop loss outperforms most of the time. And so comparing that as well to a traditional stop loss level for the same thing, 5 to 55%, we can compare these two kind of graphs and see really what happens over these periods of time. And actually from 1998 to 2009, including those two crashes, the buy and hold strategy on the traditional stop loss had the kind of lowest mean almost out of all of these strategies and even cumulative kind of losses. On the trading stop losses, the 5% actually had the lowest cumulative performance. And so that was, just shows that to have a successful trading stop loss or even stop loss, you need to still have some room for margin, especially during more volatile events. 5% is simply too close, and you can get squeezed out or stopped out too quickly. Again, in very volatile environments, that's why hedging can be more helpful than sometimes using some of these trading stop losses, where at 5%, it's just not effective at all and actually has the inverse effect, reducing any potential gains because you just get stopped out too quickly. What we see, though, is that the trading stop losses around 15 and 20% actually have the highest cumulative gain, and over 20% actually higher cumulative gain than on a traditional stop loss. So clearly we're seeing some outperformance in this trailing stop loss strategy, especially between the kind of 15, 20, 25% range, giving you enough room for margin, but also since it's not based off that fixed starting price that you have and off these gains, you can secure much more gains. You're not getting squeezed out too much, and you're not going too far with these trading stop losses that it basically just, at this point at 45%, it's reverting back to your original price, and it becomes very similar to the traditional stop losses at that fixed or based off that fixed price. So that's just leaving too much room for margin on the upside there, and on the kind of downside here at 5% is just too close, not leaving enough margin. All in all, though, you can see that the highest means come from these trading stop losses and even traditional stop losses at 15 to 20%. So those are really the key there, and they're almost double the mean from a buy and hold strategy. And again, over the kind of long run, actually going back to this graph, especially during more volatile kind of market environments, you see really significant outperformance here using trading stop losses and traditional stop losses over just a kind of normal buy and hold strategy. And then going back to that idea of 5% being too close for comfort, it's just not allowing for any gains. You're just not allowing kind of any movement at all. Obviously, you're reducing some of that downside risk. You don't see as much swings as you do with some of the other trailing stop losses here, but you're not really allowing for any gains either. So ultimately, it's just a lose-lose. 10% already is significantly higher. And then again, 15, 20% ends up being that real prime kind of spot for these strategies. And we can see that here. And again, anything more is just leaving too much room. So hopefully you guys were able to take away some different kind of key lessons from that. Obviously, allocation, diversifying, and hedging. So there are different strategies and different ways to use each that can all help create a more balanced portfolio and balanced returns. Managing the risk will also make a huge difference over the long run, highlighted by the model that we kind of just went over. And stop losses too are the easiest and most accessible way to start increasing your risk reward ratio for a trade and increasing your returns over a significant period of time, whilst minimizing that max drawdown on your portfolio. It's very easy to implement. It's not like needing to have get into some put options contracts to hedge, or trying to research and find different kind of betas to balance out your portfolio with diversification and using non-correlated assets. Stop losses really are the easiest, most successful way. Everyone should be doing them when you kind of enter a trade. And again, successful trading stop losses 15 to 20% over the long term during very volatile markets and even non-volatile markets will always yield higher returns than just a buy and hold strategy or any kind of other types of strategies. Obviously, if you're very active, if you use hedging strategies very well and are very well diversified, you can increase the return and risk reward profiles even greater. But sometimes we just don't have the resources or the time to do that with our portfolios, especially passive portfolios. That defeats the entire purpose of a passive portfolio. You want something that's, relatively well diversified. You need to account for a lot of these, allocations and be very smart about the way you allocate, not over allocating into anything. But the biggest difference that will make, especially on a passive portfolio over the long period of time, is going to be these trailing stop losses, 15 to 20%. Again, just the easiest way to reduce your risk for any type of portfolio, especially long-term passive portfolios. So thank you guys for listening. And as always, make sure to join Eagle Investors with the link in the description below. Thank you.